to be, spoken about in detail for the benefit of the larger audience here. We will go ahead and take that up towards the end of the session. One more minute and we will go ahead and start the session. All right, I am sharing my screen here. Please, can I please have a show of thumbs up if you're able to see my screen? All right, perfect. Thank you. All right. So first and foremost, as I said, we will go ahead and understand what does one mean by capital gains, what are capital assets, when do capital gains apply to you. And as a lot of us know here, there were major overhauls done with respect to capital gain transactions and taxation in budget 2024, which came about in July. So as a result of this budget coming in the middle of a financial year, now the taxation of capital gains has been divided into two timelines. The first timeline is before 23rd July 2024, and the second is on or after 23rd July 2024. So it is very crucial to understand this differentiation. So this is something we will be covering in this session in detail. Then we will talk about capital gains exemption. How can you go ahead and optimize your capital gains to ensure that you pay minimal or zero tax on all the gains you have made. And what about losses? And then we will also go ahead and talk a little bit about tax loss harvesting. Now, tax loss harvesting is something which in the recent past has gained more traction amongst users as the financial literacy increases, as the ratio of people going ahead and making investments in the stock market increases. This has also increased, so we will also take a look at that. And lastly, we will talk about ITR changes with respect to capital gain reporting. And after this, I also have my colleague Divnay joining me today, who has some exciting offers for all of you all right, for the current year filing and also for the planning for the year that lies ahead. So let's get started. Let us first understand the concept of capital assets and capital gains. What is a capital asset and what is a capital gain, and how does one connect the dots between the two of them? Simply put, capital asset refers to property of any kind held by an individual. So, when you or I buy any property, whether it is a share, land, building, jewelry, etc., all of these are regarded as our capital asset. And when we go ahead and sell these capital assets, any profit arising from these capital assets is regarded as capital gains. And on such capital gains, we will have to go ahead and pay something known as a capital gains tax. Now, these assets can either be long term assets or short term assets. How does one categorize the asset as a long term or a short term asset? Simple. It depends upon the holding period. If you satisfy the holding period criteria, the asset will get categorized either as a short term asset or a long term asset. And depending upon this categorization, we will also have the corresponding taxation. So now, having set the context of what a capital asset is, what the gains are, let us move on and understand the long-term benefits and the short-term flexibility. What is LTCG and what is STCG? Now, for a long-term capital gain, typically the holding period is 12 or 24 months. So depending upon the nature of capital asset, if you hold the asset for either more than a period of 12 months or more than a period of 24 months, it gets categorized as long term capital asset. And on the sale of such long term capital asset, any gains arising will be treated as long term capital gains. Now please remember, the period of 12 months and 24 months applies throughout for all capital assets after 23rd July 2024. Before 23rd July 2024, there was another period, the period of 36 months. However, after the budget 2024, the period of 36 months has been completely done away with. So now, after 23rd July 2024, there is no longer the concept of 36 months. There are only two periods, 12 months and 24 months. What is the long term capital gain tax? Post 23rd July 2024, the standard rate of tax for any long term capital gain is 12.5%. Before 23rd July 2024, the rate was 10%. Now, there are specific exemptions pertaining to long term capital gain, especially in the case of sale of listed equity shares or equity oriented mutual funds. So, any gain from listed equity shares or equity oriented mutual funds is exempt up to rupees 1.25 lakhs. And over and above that is where the taxes begin. Please remember, this exemption of 1.25 lakh is only on sale of equity shares, listed equity shares, or equity oriented mutual funds. Now, let us talk about short term capital gains. Now, what is a short term capital asset, or what is the general holding period? The general holding period is less than 12 months or 24 months, as the case may be. So, depending upon the asset class, we determine this holding period. And short term capital gains are typically taxed at the rate of 20% if the short term gains have been made on or after 23rd July 2024. I repeat, From 23rd July 2024 onwards, the rate of short-term capital gains is 20%. Before 23rd July 2024, the rate of short-term capital gains was 15%. Now we also have another rate, which is slab rate. So wherein your short-term assets or your short-term gains are taxed at slab rates. Now this is again for a specific asset category, which we will discuss later on. And when it comes to short-term capital gains, there is no benefit available with respect to either exemption or indexation. Moving on. Now let us understand what were the key changes brought about by Budget 2024. This is a quick snapshot of something we've already discussed in the couple of slides, the previous slides. A quick summary is this. Budget 2024 has now simplified the holding period. Earlier, there were 3 holding periods, 12 months, 24 months, and 36 months, which has now been revamped to 12 and 24 months. 36 months holding criteria has been completely abolished. Long-term capital gain tax have been exceeded from 10% to 12.5%. Then LTCG exemption has increased from 1 lakh rupees to 1.25 lakh rupees. When it comes to tax rate for short-term capital gains, the rates have been increased from 15% to 20%. Please note that indexation benefit has been completely done away with. There are no asset categories now where indexation benefit will apply. However, if you are an individual who has purchased a land or building before 23rd July 2024 onwards, before 23rd July 2024, you can still continue to apply the indexation benefit. I repeat, if you have purchased land or building before 23rd July 2024, indexation benefit can continue to apply if it is beneficial. So now, for any property purchased before 23rd July and the sale effected after 23rd July, the taxpayer will have 2 options. One, to offer it to tax at the rate of 12.5% if it is a long-term capital asset, or alternatively use the 20% rate with indexation. Now let us understand how do holding periods impact your assets post 23rd July 2024. The first asset category that we will discuss is listed equity shares or equity oriented mutual funds. The holding period cutoff here is 1 year. If you hold it for more than 12 months, it will be regarded as long-term capital asset chargeable to tax at the rate of 12.5%. Please remember, long-term capital gains up to rupees 1.25 lakhs will be exempt. On the other hand, if you hold these listed equity shares or equity-oriented mutual funds for a period less than 12 months, they will be regarded as short-term capital asset and chargeable to tax at the rate of 20%. If you hold any immovable asset, currently the holding period cutoff is 24 months. If you hold it for a period more than 24 months, it will be regarded as long-term capital asset chargeable to tax at the rate of 12.5%. Please remember, if you have purchased the land and building before 23rd July 2024, you will have an option to opt for indexation benefit as well. On the other hand, if you go ahead and hold the immovable asset for a period less than 24 months, it will be chargeable to tax at the applicable slab rates. Any other capital assets such as gold, unlisted shares, etc., the cutoff period is 24 months. If held for a period of more than 24 months, they are regarded as long-term capital assets and the applicable rate on their sale is 12.5%. On the other hand, if you go ahead and hold any of these capital assets for less than a period of 24 months, they will be regarded as short-term capital asset chargeable at the slab rates. Now let us talk about debt-oriented mutual funds. Post the budget announcement in 2024, all debt-oriented mutual funds, irrespective of the holding period, will be categorized as short-term asset only. And any gains arising from such debt-oriented mutual funds will be chargeable to tax at the applicable slab rates. I repeat, after Budget 2024 announcement, debt-oriented mutual funds will always be regarded as short-term capital asset chargeable to tax at the applicable slab rates. One very important thing here, let us understand grandfathering clause. Now, before we do a deep dive into grandfathering clause, the asset category to which it applies, let us first understand the concept of grandfathering. In very simple terms, grandfathering refers to providing protection against an earlier tax treatment which was more beneficial to the individual taxpayer. So now I hope the concept of grandfathering is explained. Now let us understand what are the asset class for which we are talking about this grandfathering. Today we are discussing grandfathering for equity shares or equity oriented mutual funds. So now, before 2018, specifically before 31st January 2018, any gains, any long-term gains arising on sale of equity shares or equity-oriented mutual funds was fully exempt. However, in budget 2018, there was a significant change made. This exemption was completely done away with, and now long-term capital gains was applicable on sale of equity shares or mutual funds at the rate of 10%. However, to safeguard all those taxpayers, all those individuals who had made investment in equity shares or equity oriented mutual funds before 31st January 2018, grandfathering clause was introduced. Now, this grandfathering clause enabled the individual to lock in the purchase price so as to protect any gains that they may have made before 31st January 2018. So now let us understand, if you have purchased any equity shares or equity oriented mutual funds before 1st February 2018, what will be the tax treatment? Here, the most important thing to consider is the cost of acquisition. So the cost of acquisition for any purchase made before 1st February 2018 is higher of the purchase price, that is the cost price or fair market value as of 31st January 2018. And in case your sale price is lesser than the fair market value, in that case, the cost of acquisition will be the lower of the fair market value or the sale price. Simply put, or let me give you a numerical example to help understand better. Let us say you purchased listed equity shares of ABC Limited on 1st January 2016. So the purchase price on 1st January 2016 is rupees 10. You decide to sell these shares now on 1st January 2025. So on 1st January, you sell these shares at rupees 1000 per share. So typically 1000 minus 10, 990 rupees will be your capital gains, right? However, since these shares were purchased before 2018, grandfathering clause comes into picture. Now your purchase price will be higher of the purchase price, which is rupees 10, or the fair market value as on 31st January 2018. Let's presume your fair market value as on 31st January 2018 is rupees 600. So in this case, the higher of 10 or 600 is obviously rupees 600. So now your gains will be rupees 1000 minus rupees 600, which comes up to rupees 400. So now grandfathering is helping you save taxes by offering lower capital gains. So here your cost will no longer be 10, it will be the fair market value, which is rupees 600. So instead of long-term capital gains of 990 rupees, your revised long-term capital gain will be rupees 400. I hope this is clear. And now for the applicable tax rate will be before 23rd July in the case of long-term capital gain 10%, short-term capital gain 15%. From 23rd July 2024 onwards, long-term capital gains are 12.5% and short-term gains are 20%. ITR reporting requirement, very simple. We will have to give a script-wise detail. That is to say a line-wise detail of all the sale made. I hope this is clear. Moving on, let us talk about the carry forward and set off rules in the case of long-term or short-term capital loss. So far, we have discussed about the gains, the taxability of the gains, grandfathering provisions, the rates of taxes, pre and post budget, all of this. Yes, but what happens when there is a loss? Again, the treatment of loss is distinct for both long-term capital loss and short-term capital loss. Let us start by talking about long-term capital loss. If you have made a long-term capital loss, such long-term capital loss can be adjusted only against long-term capital gains. You cannot adjust your long-term capital loss against any short-term capital gain. However, if you have a short-term capital loss, such short-term capital loss can be adjusted both against long-term capital gain and short-term capital gain. Most importantly, both long-term capital loss and short-term capital loss can be adjusted only against capital gains. They cannot be adjusted against any other income source, such as income from salary, income from house property, income from PGBP, etc. I repeat, any long-term or short-term capital loss that you have can be adjusted only against capital gain income, not against any other head of income. Lastly, if you have made capital losses and do not have any capital gains in the current year, worry not, you can go ahead and carry forward your losses, both long-term and short-term losses, for a maximum period of 8 assessment years. Here is where things get interesting. If you want to carry forward these losses, you have to ensure that you file your return of income within the due dates. So for assessment year 25-26, the due date of filing the ITR for individuals is 15th September 2025 if you're not subject to audit. So if you file your return of income correctly within this due date, in such a case, you can carry it forward for 8 assessment years. Now, what happens if you have missed the ITR filing deadline? If you miss the ITR filing deadline, or you do not file the return of income, or you're filing a belated return or a updated return, that is ITRU, in such case, you will not be allowed to carry forward these losses. And this is why it is very important. It becomes very pertinent for you to comply with the provisions of the income tax law with respect to filing the ITR on time. Now let us talk about everybody's favorite topic, how to save taxes. What are the capital gain exemption provisions? Now, before we do a deep dive, let me please explain that, or let me please clarify. Exemption from taxes is available only in case you have a long-term capital gain. Only in the case of long-term capital gain, you can go ahead and avail capital gains exemption. Now here we are taking example of two friends, Ramesh and Suresh. Both the friends have sold a property, but they have sold different types of property or different type of asset. Let us understand what are their gains and what will be the capital gain exemption that they enjoy. So Ramesh has sold his land and Suresh has sold shares and equity mutual funds. Let us understand now how will the capital gain work out and how will the capital gain exemption work out. For both Ramesh and Suresh, we have taken some common denominators. The value of both their original asset, that is land in the case of Ramesh and equity shares and mutual funds in the case of Suresh, is rupees 50 lakh. The sale price is rupees 80 lakh and their capital gain is 30 lakhs. 30 lakhs is 80 minus 50 lakhs. Now Ramesh has invested in residential property worth 40 lakhs. Suresh has also invested in residential property worth 40 lakhs. Until here are all our common points or the common facts. Now let us understand what is the gain exempt. For Ramesh, the exempted gain is the full value of gains, which is rupees 30 lakhs. However, for Suresh, the exempt value of gains is only rupees 15 lakhs. Let us understand why. Because both of their cost price was same, their sale value was same, capital gains is same, even their investment is the same. Both have invested in a residential property. However, why are the gains, the exemption differing? Why is Ramesh getting a gain of 30 lakh vis-a-vis Suresh getting a gain, a capital gain exemption of only rupees 15 lakh? The difference lies in the asset that they have sold. So Mr. Ramesh has sold land and reinvested in a residential property. On the other hand, Mr. Suresh has sold anything apart from land or building. That is, the asset that he has sold is a share or equity oriented mutual funds. Now, let us individually take a look at these different asset classes and understand the rules and regulations. When it comes to sale of land, if you have sold a land or building and reinvested your capital gains in another residential property, the rules differ. The rules of exemptions differ. The exempt value is lower of the capital gain or the amount invested in the new house. So in this case, it will be lower of either rupees 30 lakhs, which is the capital gain, or the amount invested in the new house, which is rupees 40 lakh. So 30 lakh being the lower amount will be the capital gain exempt. In example 2, for Mr. Suresh, wherein he has gone ahead and sold shares and equity mutual funds, in this case, the exempt value will be proportionate basis the sale proceeds. So if you're selling anything apart from land or building, you need to go ahead and invest the entire sale consideration. Or if you have not invested the full value of sale consideration, your capital gain exemption will be proportionately computed. So in this case, in the hands of Mr. Suresh, his capital gain 30 lakh is proportionately divided on the basis of the reinvested value and the sale proceeds. So 30 lakh into 40 lakh, which is the new investment, by 80 lakhs, which comes up to rupees 15 lakhs. And this is the exempted value which Mr. Suresh is enjoying. Now, in both the situation, there are certain common conditions to be satisfied. Let us understand what they are. There is a time limit for investment. So from the time you sell your capital asset, there is a time limit for investment. You can go ahead and invest in a residential property 1 year before the sale or 2 years after sale. And in case you want to go ahead and construct, you can do so within 3 years from the date of sale. The maximum exemption available is rupees 2 crores for purchases of two houses if you have sold land or building and reinvested in a residential property. On the other hand, if you have sold any other asset apart from land or building, in that case, the maximum exemption you can enjoy is up to rupees 10 crores. The lock-in period of the new investment you have made in both the cases is 3 years from the date of acquisition or construction. Now, one may wonder, what happens if I'm not able to invest this amount, or I am a first timer who has gone ahead and sold an asset? I was unaware of any of these exemption conditions, or I could not make up my mind. I'm still not able to make my mind whether I want to invest in a property or not, or whether I want to invest in a ready to occupy property or I want to construct my own house. These are important decisions to be made. What can be done? There is an alternative. You can go ahead and open a CGAS account, that is capital gains account scheme account, with any of the scheduled banks, and whatever is the amount of gain or the sale proceeds, depending upon the asset you have sold, you can park it in this CGAS account. This CGAS account acts a little bit like an escrow account wherein the funds are intact, and this serves as a proof of intent that you intend to go ahead and make the investment in capital gain exemption assets further on. So you can go ahead and park this there. Now there is a time limit for you to go ahead and deposit. Typically, the deposit in CGS account can be made before the due date of filing the ITR. So if you have not been able to go ahead and invest in a residential property, you can consider depositing the money in a CGS account, and later on you can go ahead and invest the proceeds in a residential property. What happens if you go ahead and sell the property that you have invested in? The lock-in period is 3 years, and within this lock-in period, if you go ahead and sell the property, whatever were the value of capital gains exempt, they will become fully taxable in the year you breach the lock-in requirement. I hope this is clear. Let us take a look at another alternative. What happens if Suresh and Ramesh do not want to invest in a residential property? What if they do not want to invest in residential property? Can they still claim this capital gain exemption? Let's take a look at it. Absolutely, yes. There is another alternative. You can go ahead and make an investment under Section 54 EC, which refers to investment in NHAI or RECL bonds. Again, we have kept the facts of the case same. The cost of original asset was rupees 50 lakhs, sale value rupees 80 lakhs, and the capital gain rupees 30 lakhs. With these facts in mind, let us understand what will be the amount of exemption. First and foremost, you can consider investing in NHAI or RECL bonds. The exempt gains in this scenario will be rupees 30 lakhs. The exempt value as per the provisions are lower of the investment amount or rupees 50 lakhs. So the invested value here is rupees 30 lakhs or rupees 50 lakhs, which is the upper limit given under Section 54 EC. So rupees 30 lakhs being the lower value will be the amount which is exempt. Now, what is the time limit for investment? All investment in NHAI or RECL bonds must be made within 6 months from the date of sale. This is very important. What is the maximum exemption one can claim? The maximum exemption is rupees 50 lakhs. What is the lock-in period? Investment in NHAI or RECL bonds come with a slightly higher lock-in period of 5 years from the date of investment. Is CGS deposit available? No, CGS deposit benefit is not available if you want to invest in NHAI or RECL bonds. What happens if you go ahead and sell within the lock-in period? Or what happens if you decide to withdraw the investment? Whatever were the exempted value of capital gains, they become fully taxable. I hope this is clear. Now let us understand what is tax loss harvesting. Before we do a deep dive into tax loss harvesting, we must understand the concept. Tax loss harvesting is a very simple hack which one can employ to go ahead and reduce their overall capital gains. This capital gain can either be long-term gain or short-term gain. How it essentially works is, if in any particular financial year you have made huge value of long term or short term gains, and at the same time if you have certain non performing assets or certain loss making investments, you can go ahead and sell off these loss making investments, and whatever is the loss arising thereon, whether it is long term or short term loss, or you can set off these losses against the respective gains so as to reduce your overall gains. This is known as tax loss harvesting. Now let us understand how does it play out in a real life scenario. We have taken the example of Mr. Ramesh, who is an IT professional with a salary of rupees 15 lakh. Now Mr. Ramesh has made a short term capital gain of rupees 2 lakh. His tax liability on this gain is rupees 40,000, presuming that this gain was made after 23rd July 2024, where the applicable tax rate is 20%. Now, Mr. Ramesh has an unrealized loss of rupees 1,20,000. So, what Mr. Ramesh can do here is this unrealized loss, he can convert it, he can crystallize it, he can choose to sell these loss making mutual funds and adjust this value of short term capital loss against the gains that he has made of 40,000. So now the action that he will have to take is sell his loss making funds and repurchase similar funds if he wants to stay invested. So what happens now is the taxable gain offset is rupees 80,000 and the revised tax liability comes up to rupees 16,000. So in effect, Mr. Ramesh ends up saving rupees 24,000. Now, couple of things with respect to tax loss harvesting is typically most investors undertake tax loss harvesting at the end of the financial year, but that may not be the right approach because you also stand to lose out on opportunity loss. It is ideally an exercise that needs to be carried out throughout the year so that you also ensure that you don't go deeper into the loss trap. You cut your losses as soon as possible, and also you have time, ample time to go ahead and reinvest. This also saves you from enhancing your losses. I hope this is clear. Now, last bit, let us talk about ITR changes with respect to assessment year 25-26. Please remember these ITR changes focus on capital gain requirement and are currently restricted to ITR 1 and 4 only. Most important and a welcome change, ITR 1 and 4 filers can now go ahead and declare long term capital gains up to 1.25 lakhs in ITR 1 or 4. Most importantly, only gains from listed shares or equity oriented mutual funds can be reported. If you have any other gains, then you will have to move to ITR 2 or 3. If you have a loss, a short term loss or a short term gain, you will again have to move to ITR 2 or 3. If you have any long term loss, you will have to move to ITR 2 or 3. It cannot be reported in ITR 1 or 4. If you have brought forward losses from the previous year or you want to carry forward losses to the next year, once again you will have to opt for ITR 2 or 3. You cannot continue under 1 and 4. Most importantly, there must be a segregation or a differential reporting of all the transactions on before and after 23rd July 2024. So, in a nutshell, if I have to say, if you are positive, if you are capital gain positive on sale of listed shares or equity oriented mutual funds, only then you can file ITR 1 or 4. ITR 1 and 4 is only to report gains. The moment there is a loss or there is a gain from short term asset or there is a situation of carry forward or brought forward losses, you will have to opt for ITR 2 and 3 itself. A point of caution here, a trend that we are observing is a lot of taxpayers in a hurry to file their ITRs are opting for ITR 1 and 4 by declaring only gains. I would highly recommend, please do not do this. It is very important that you file the right ITR, and also please remember, while if you have a loss, if they are not able to give you an immediate advantage, losses can also be carried forward into the future years. And in the future years, whenever you have a gain, you can offset those gains with these carry forward losses. So please be patient, wait for ITR 2 and 3 to be released if they are the forms relevant and applicable for you, and only then go ahead and file your returns. It is important to file the right returns while also ensuring the right tax treatment. With this, we come to an end of today's presentation. I know that a lot of y'all are waiting for the Q&A, and I can see that there are a lot of questions. And although our team is trying their best to answer all questions, there are still a few unanswered questions. I will come to that. Before that, I will quickly let my colleague Divnay take over. He will take 5 to 10 minutes of your time and give you a very great and interesting offer. So over to you, Divnay.
Okay, sorry. I'm audible now. Great. Good evening, everyone, and thank you so much for being a wonderful audience. I hope I'm audible now, and thank you so much for sharing so much love for Clear Tax. I hope this was a very insightful session, and mostly to everyone who is working really very hard to grow their money and investing in uh, multiple set of investment class. I was also going through the lot of queries wherein a lot of people had multiple queries with respect to what should I be doing for certain kind of indexation benefits from Mr. Rajesh. When it was Mr. Shrikant, it was more to do with some problem statement use case wherein there was a particular set of investment sale of land which went into a dishonor, and then the payment was realized after 2 years, how he can make sure he gets the capital gains benefits by reinvesting. The other things were with respect to the type of, do I qualify for income tax or not, because with my 4 lakh of investment across 3 different types of this from Utsads and Mr. Sudeep talking about stamp value difference in value of the land to the actual capital gains paid. So the difference in between that. There are a couple of questions with respect to multiple use cases, like if there is a split in stocks, holding period for foreign assets, because of multiple changes which has happened. And that's the reason this is very important that we have very experienced tax experts like who are here on screen and off screen at Clear Tax, helping you solve your multiple queries, because each one query could lead to a significant differential in taxable amount. So, and then that's where you look forward for a wonderful tax expert to manage your taxes. And so as Clear Tax, we decided that we would curate certain wonderful plans that would not help you looking for and scout for a tax experts, where you're not stuck with queries like where would I find a right tax expert, who would spend enough time with it, will that who how will I make the tax expert liable for any kind of a calculation, or is there a third party who can handle that if there's something goes wrong with the tax experts, what happens. So that's why Clear Tax created a curated Clear Tax Assist plans. Here, Clear Tax makes sure that they shortlist the tax experts who is gonna file for you and match them for your filing based on their experience, based on their customer score and reviews. So getting into those details, this is very important because when you hire a tax expert, he or she may not be directionally doing the right set of things, or there is no third player who is vetting up this up. And this is where Clear Tax comes into the picture. When we match a tax expert, we make sure that whatever set of queries, whatever set of complexities you have in your tax filing, that caliber of tax expert is being judged upon by Clear Tax and assigned to you. Once a particular set of documents are being vetted, the tax expert does the complete tax computation, and it is being maintained on standards of Clear Tax. So anything going wrong, we take up the complete responsibility, and we make sure that the tax expert corrects it immediately free of cost for you, even if it is for revised filing, or fix up things if in case that has got some kind of a notice or any kind of a departmental questioning. So we take end to end responsibility, and we also make sure that if a tax expert is not making sure that your particular set of things are not resolved, then we assign another tax expert and make sure that that thing is achieved. When it comes to your filing, we have created certain set of guidelines in our Clear Assistance plan, which is we make sure the tax experts files within 24 hours of you booking up the plan. We provide a dedicated relationship manager who actually makes sure that the tax expert responds to you real time basis. He gets on call with you on video consultation on how many times you have requested for, and He also supports you for any kind of tax planning, tax saving queries throughout the year. And we have just grouped this all features together under a Lux plan, which is specially for investors like you who have multiple queries, who have multiple problem statements, wherein you have large investments where you want to save tax under Section 54F, 54. You have certain roadblocks. You want the tax experts to go and refer to some affiliate cases and solve this in the best interest of your maximum tax refund, making sure your compliances is top notch, whether it is intraday or FNO, whether it is long term capital gains or short term capital gains, everything the tax experts takes care. And that's the reason we created a plan wherein the tax expert is end to end responsible from your filing to your data consultation, to your notices, to all your future queries on your future investments and how he can help you go for this. And thank you so much for valid feedback on the price, uh, wherein the price is directly attributed to the value which we get, because we make sure for the next one whole year you get a complete support from a tax expert. This is not one time transactional thing wherein he does filing for you. He would be responsible for your end to end tax planning and end to end tax savings for the next financial year, because a lot of changes have come in. The 12 lakh rupees rebate has made new scheme more interesting, but you still continue to do a lot of expenses on your home loan, and home loans have become pretty cheap these days, and you wanted to save tax over there. There's old regime comes with a lot of other compliances and regulatory requirements with entering numbers, EPFO, all these details. So tax expert will guide you throughout the year, end to end. Whenever you are doing some investment, you need to make sure that you save all these documents and keep and provide me all these details, so that when it is to comply for next year tax filing, all your documentation and all your things are covered over here. This, we have made it very price effective for our webinar audience, because this is the audience who looks up to ClearTax, who follows us, who loves our webinar, asks the valid questions. We enjoy giving the right consultation to these set of customers, and that's the reason we have slashed that price from 37,000 to 13,125 rupees only for our current webinar customers, wherein you get end-to-end unlimited video consultation, guaranteed 24 hours filing, any previous year's uh, query of ITD which is to be handled would be taken care, your complete consultation on all your capital gains requirement and maximize your refund guarantee, any set of notices which comes in future. Like for example, currently government has started integrating a lot of data points. If you have taken some kind of an 80 ggc donations, political party donations, you have done more credit card spends than your annual income, which is to be required to be compliant with the ITT. All these things will be taken care by your tax experts. You will be completely protected from any kind of uncertainties arising for the best tax savings which you have done with our tax while filing with our tax experts plan. So your filing is covered, your notices are covered, your future queries are covered, your planning is covered, your saving consultations are covered, and anytime availability CA is covered. Just at 13,125 rupees for 1 year long. And this price is only valid till end of this particular webinar. And this is the QR code to go and apply this coupon code and save your tax, plan your tax filing, and get the right tax expert matched without even going and looking for thousands of tax experts, their reviews, because there are a lot of new things which are coming up. And there are not new things of notices which are coming up. With Clear Tax as a standard keeps training their tax experts up to date with respect to how the overall trend of ITR filing is changing. You have any questions with respect to this particular plan, you can please ask this on the chat. We are here to assist you, and you can use this coupon code to get this offer. This particular offer is not live on our website. It's not available to anyone in the only for our attentive, interested webinar audience of Clear Tax only. When is the last date to file ITR for 24-26? It's 15 September. It's not 26, 25. Will the Lux plan be available in future? Lux plan would be available in future, but Lux plan will not be available at this price. The actual starting price of Lux plan is 20,000 rupees. The price in the next 1 week, and post that it will be priced at 37,999. Currently it is priced at 15k, because this is only specially the webinar invite. Clear Tax as a business always believes in giving values to its customer. We run this webinar only for our very loyal set of customers or people who look up to Clear Tax for any kind of an taxation knowledge, and we are very happy that we have been able to cater you, and hence we created this plan, and we are just providing this plan right now. How to avail this offer? You just need to scan this QR code, and just scan this QR code, or you can check out the link in the chat which is pinned, and you can just go select the luxury plan, check it out, apply this coupon code. The price will reduce to 13,000 rupees, and you will be able to buy this now. Is there a family for husband and wife? We would be able to help you with the family plan. We will take this query. You can go ahead and buy this plan right away, right now, with this QR code. And once you have done this, we are going to share a form after this. Once you have confirmed buying this plan, we'll share a form with you. If you want to include your husband, then there will be an add-on cost, not completely to the luxury plan, but only to the plan for which is required for your spouse, whoever is the other person. It would be between basic, premium, and this, that our sales rep will help you upgrade. Within the same plan, you will be covered under luxury, which will be a package for you. With QR code, you will be able to visit the website, and when you are checking out, you will have to apply the coupon code, because this coupon code is not visible in the public domain. This is only visible in the webinar, and you will be able to check this out. Meanwhile, our tax expert team is trying to answer all your questions with respect to any of your capital gains related queries. We have a team of 5 tax experts sitting up in this webinar and helping you solve your queries, because our core ethos lies in driving value to you, and that is the key motto of Clear Tax, that whatever we do, we make sure that our best customers deserve the best set of products, whether it is webinar queries, answers, the plans, the discounts or pricing, or the complete value proposition which we provide. A normal CA would take 2K for filing. I completely agree. It could be variable. There are multiple other use cases. It depends upon time to time. But at Clear Tax, you may not have to deal with a normal CA. He or she may or may not be interested in your filing over a period of time, because they may have some high value customers. And this plan gives you an experience of a relationship manager who makes sure that the CA is available. He takes your queries. He understands all you. He helps you with all the documentation. A normal CA will not provide you free notice management throughout the year or any notice which arises with respect to your filing. If that notice requires refiling couple of times, we will do it for free throughout the year, because there are multiple regulations and regulatory requirements which keep popping up with the uh, AI based notice generation by the ITD, and all these things will be all at additional charges and appointment with a normal CA. And the most important thing is that once you take up this plan and submit the documents uh, which your uh, relationship manager will help you collect all the documents, you will get guaranteed filing done within 24 hours. All these things you will not get it from CA, and this is where ClearTax makes sure that we provide value, we make the CA accountable, and we do all those things which is required for a taxpayer, and you be stress free throughout the year. Now I'm handing over to Megha. As decided, she'll be taking up questions. Whichever is not answered, we will take this up. Just before I hand it over to her, I would just like to share that people who have, for example, I can just point out for people with very simple case like Mr. Utsav Biswas, where he like sold shares worth rupees 40 lakhs long term and invest 6 lakhs in shares. Do I get any exemptions? Or people with very simple use cases, Mr. Bharat Kumar, where aggregate income includes short term, long term gains in interest and intraday. Everything is below 4 lakhs. You may or may not be thinking that I may require a luxury plan, but I would recommend everyone to go for luxury plan, because you don't know what you have traded or you missed on this thing. Luxury plan will help you plan all your tax filing and tax related queries. Now just go to other set of plans. We have basic, premium and elite, which you can find in the same QR code if you scan up, where we do not have any specific offer. This is for your filing related requirements, where you will just get a video consultation while filing your taxes. And this is where someone pointed out, I get a CA for a particular cost. We also make sure that we give you a CA at a particular cost. Here we want to give you a value to the, and we make sure that the tax experts give you the right set of filing, the right set of maximum refund, and a consultation while filing or calculating your computation. But you do not get is that you don't get throughout the year filing or tax refiling and the tax consultation benefits, and you do not get the complete tax planning, tax saving hack, or any kind of a consultation which you want to do with your tax expert throughout the year, anytime, anywhere, or get your tax expert multi query, or you get an additional tax expert advice. All these things will be powered by the Lux plan. And I would surely share, I would request, I will be sharing a form for people who would be interested into family plan. We would surely help you through that, and request you to just go ahead and take this base plan and fill up that form, and we will upgrade your plan to the family plan by connecting with you based on the complexity of the income types of your spouse, and we will include the same spouse within that particular luxury plan. In one luxury plan we'll include two with an additional cost of basic filing. Wherever the other spouse comes into, it is base or this, and we'll give you a combined benefits. Just the form is shared on the link. Please take this plan and fill up this particular form, and we will get back to you shortly. Currently, in this current Lux plan, only one ITR will be filed, Shivam. And if you want a spouse to be added, the other spouse or the family member will be added as a part of the other packages, and they will all enjoy the Lux plan benefits. You can fill up the form, Ajay, uh, with respect to the family plan. Get you can buy the Lux plan and go ahead and fill that particular form. The team from ClearTax will reach out to you to add your family members and give you a complete details on that. I I invite again Megha to take up the questions with respect to this. And any queries, if anyone else also has any other queries with respect to the Lux plan, you can also fill up that particular form and we will call you up one on one and get back to you.
Thank
Thank you.
you. Thank you so much, Divne. I hope this must have answered a lot of your questions on including another family member, or if you want year-long advisory. So I think Divne has answered most of the questions. If you still have any other queries, questions, please drop them in the comment box. Our team will definitely get back to you. We have also provided our email addresses where you can write to us, and rest assured, we will get back to you within 24 working hours. Now I do see that there are certain unanswered questions in the Q&A box. First and foremost, thank you so much to the participants for asking these questions and also patiently waiting for us to go ahead and answer these questions. So let me quickly take them up. And some of these questions are those which can, go ahead and benefit the larger audience also, because these are questions which can have an impact on everybody here. The first question that we have is, I have some capital gain amount. Since ITR due date is extended by 15 September, can we deposit this amount in capital gain account scheme by September 15th, or do we need to do it by 31st July? So the time limit for depositing the money in the CGS account is typically before the due date of filing the ITR. So you can go ahead and file this anytime by 15th of September. However, please remember, in certain cases, it is 6 months from the date of sale or due date of filing ITR, whichever is earlier. So make sure that you do not breach the timeline. And if the funds are surplus and simply lying in your savings account, the prudent advice would be in this case to go ahead and make the deposit sooner. And the process of opening a CGS account is very simple. All you have to do is go to the bank, let them know you want to open a CGS account. Typically, in one or a maximum of 2 working days, the account is opened and the seamless transfer of funds happen. There is another question. I want to do a STP from a large cap to debt. Would it be taxed? So, whenever you decide that you want to go ahead and shift your funds, whether within the same category or a different category altogether, it is regarded as a transfer. So, yes, if there is any differential gain, such gain will have to be offered to tax. How to declare foreign stocks over 20 in ITR? A very valid question, and this is a question which a lot of taxpayers here, a lot of our members here may have. So if you have a foreign asset, even if it is one stock, as a tax resident Indian, you are mandatorily required to go ahead and disclose the same in your ITR. Now, where does one disclose these foreign assets? To disclose any type of foreign asset, whether it is foreign equity, foreign debt, a foreign bank account, or any other foreign asset, for example, land or building overseas, all of this can be entered in Schedule FA or Schedule Foreign Asset of the ITR. Now, this Schedule FA is available in ITR 2 and 3. So, if you have a foreign holding, your ITR shifts from 1 to 2, and you have to go ahead and make the declaration in Schedule FA. The next question is, what head is FNO income loss taxed? Business income. Absolutely yes. Any gain or loss that you have from FNO will be regarded as business income or loss, as the case may be. And also, just adding on to this question on FNO income loss, we will also some of the upcoming webinars, we will have a dedicated session on intraday trading, on trading for FNO folks into FNO transactions. We will go ahead and do a detailed analysis of the taxation, the audit requirements, the key do's and don'ts to be kept in mind. So please wait for that webinar, and we will definitely help you understand this entire gamut of taxes and rules and regulations around FNO and intraday trading better. All right. The next question, a very important question, a very valid question. AIS and 26 AS is different. There is a difference in 26 and AS and AIS, and 26 AS is beneficial to me. Then should I follow 26 AS? Now, this is something time and again we are asked by a lot of people. You know, there is a difference between my Form 16, 26 AS and AIS. So, in this case, first and foremost, the thumb rule is you are required to go ahead and report your actual income. If in the case, let's say that 26 AS has rupees 15 lakhs, AIS has rupees 20 lakhs. Now 26 AS may be more beneficial because simply put, the amount appearing there is lesser. In this case, what you actually have to do is first assess and establish what is your actual income. Is it 16 lakh, 20 lakh, or any other value? If that is the case, please go ahead and report the right income. As regards this differential, it may so happen the reason for this difference is that your Form 26 AS is not fully updated, or your deductor has not gone ahead and showed the TDS for quarter 4, or maybe the AIS is showing you the clubbed value of your salaries from 2 employers. Maybe you have moved your employment during the year. So there could be various possible reasons. The best course of action is to first dissect and understand the reason for the difference. If it is a valid reason, then please go as per AIS. If it is not, then go as per the actuals. And please remember, if there are any incorrect entries in the AIS, you can go ahead and apply for a change by submitting the feedback. So on your IT portal itself, once you go to the AIS section, there will always be an option on the right side, submit feedback, provide feedback. You can go ahead and provide a feedback if you disagree with any of the entries in the AIS. I hope this helps. So there was another question, how to save maximum tax using capital gain route with losses set off with other NPA. So this is the crux of the concept of tax loss harvesting, which we have discussed. I hope you have understood how you can optimize your capital gain tax by utilizing tax loss harvesting technique. All right. So the next question is for someone with salary, bank interest, dividend, short-term capital gain, which ITR form is correct? Since you have short-term capital gains, you will have to file ITR 2. All right. If an apartment is registered under my name but rent is transferred to my wife's account, am I liable from a tax perspective, or would it be computed against my wife's return? So this is again a very, very common question we get asked, that the house is under my name or it is a jointly owned property. Either my spouse or one of my parent is, getting the rental income. So will it be, taxed again under my name? Yes, in this case, under the provisions of the IT Act, whatever income your wife is getting, it should be ideally clubbed against your income, unless the wife is earning a higher income than you are. So please be very mindful of this, because this exercise or this setup that you have just explained, or that I have just explained, is viewed as a tax evasion exercise by the income tax department. To curb this activity, what the income tax department suggests is whatever is the rent being diverted to the wife's account should be clubbed in the hands of the husband itself, unless of course the wife is earning more than the husband or equal. All right, there is another question. As an NRI based out of UAE, am I eligible for tax exemption on capital gains generated from sale of mutual funds in India? Yes, if you're a tax resident of UAE, in UAE, there is an exemption on any capital gains you make. and the capital gains you make are taxed only in the UAE. As a result of this, you will continue to enjoy full exemption on your capital gains derived from India. All right, there is a question on I purchased a property in 2019, I sold it in 2021 with a consideration of 70 lakhs. So in this case, if you're going ahead and making the reinvestment in another property, you need to invest the entire amount of capital gains to enjoy the exemption. If you decide to make an investment in RECL or NHAI bonds, in that case, you can invest up to rupees 50 lakhs. Please be mindful of the period of investment and also certain investments. For example, if you're making a 54F investment, you cannot have more than 2 house properties. So these are a few things you need to be mindful of, the adjoining terms and conditions. If you satisfy all these terms and conditions, then you're good to go. All right, there is the next question. What is a good time to file ITR, as it takes time for TDS and TCS entries to show up in 26AS, etc.? Absolutely right and very valid. Typically, what we say is once you get your Form 16, immediately log into your IT portal, check your 26AS and AIS. Usually, by the time an individual gets Form 16, the 26AS is also fully updated. One check you can do is to go ahead and see if all the 4 quarters entries are in your 26AS. If yes, then you're good to go. You can go ahead and file your ITR. Yes, absolutely. The session is being recorded and the session will also be shared along with the presentation. So you can refer to the both recording and the presentation at a later point in time. Foreign listed shares are categorized as foreign assets and they must be reported in Schedule FA. All right. So if you have a short-term capital gain, the applicable ITR for you is ITR 2. ITR 2 is not yet out, so you will have to wait for the utility to be released so that you can proceed with the filing. All right. So there is a question that I have a lot of losses in mutual fund investment. Which ITR should I file? So we need to first understand if for financial year 24-25 these losses were realized or not. If the losses have been realized and you have to carry forward these losses, ITR 2 is your ITR. But if these are merely unrealized losses, all right, that is to say, as of 31st March 2025, you have not sold these. In that case, you can, keep them aside because they will not have an impact on the ITR selection. Your ITR selection will be based only on the income streams that you have and any foreign asset that you may have. Accordingly, you will be required to file ITR 1 or 2. All right, so we will take up last couple of questions before we call it a day. I do understand that there are some questions which have not been answered. Please be assured we do have our tax experts in the background as well who are continuously answering your questions. So most of the questions will not go unanswered. Please do not worry. All right, another very valid question. I have ESOPs that I have exercised. These are currently not cashed or realized. What do I do? So, if you have exercised your ESOPs, if they are vested, so they become foreign holdings, they become foreign assets. And whether you have cashed them or not, it becomes pertinent that you go ahead and report the same in your ITR. This is very, very important. You must go ahead and report them in Schedule FA, that is Schedule Foreign Asset, and the relevant ITR for the same will be ITR 2. Yes, if you have a short-term capital loss, the relevant ITR will be ITR 2. All right. The last question I have: capital gains from equity and mutual funds. How do we save tax in the last? How do we save taxes? Considering now we are using the new slabs. So, irrespective of the regime that you are in, if you have long-term capital gains from sale of equity, listed equity or equity-oriented mutual funds, you enjoy a flat exemption of up to rupees 1.25 lakhs. And the investment opportunities that we spoke about, investment in a residential property or investment in NHAI or RECL bonds, all these exemptions are available irrespective of the regime you opt for. So whether you are under the old regime or the new regime, all these exemptions are available on an as is basis. So you can go ahead and make the right investment if your gains exceed more than 1.25 lakhs. And if your gains are within 1.25 lakhs, in that case, they become automatically exempt. So with this, we come to an end of today's webinar. Thank you so much for being such a wonderful audience. Thank you for asking so many good questions. We had such great questions today, and we have also made a note of a lot of questions. And we will try to, come up with a separate webinar on ESOPs and RSU taxation, their presentation in the ITR. We are also planning to come up with more webinars on FNO, trading, business, and as and when the ITR utilities for 2 and 3 are released, we will also have a webinar breaking down ITR 2 and 3 in the simplest possible manner to all of you all. So until next Wednesday, have a great time. See you all. Bye bye.